Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. To get started, we're going to talk about active versus passive investing. We have a lot of people that we meet with on a weekly basis. They will ask that specifically. Should I be in investments that are buy and hold strategy, that I just go with the market, or should I be in a more active managed account that looks at geopolitical issues and economic issues and looks at some trends out there and does some trading and investing based on those? An example of something like that is, we have some significant volatility yet in the market due mainly to geopolitical issues. And as a result, there are certain investments that we tend to pull back on in these portfolios, in the active managed portfolios, because we feel they're hit by tariffs. So until a trade deal is in place, you can look at those things and actively manage the portfolios and stay away from certain issues that are affecting portfolios economically. Those issues right now would be, for instance, tariffs. If you look at a passive investment, again, what you're trying to do is you're trying to take a balanced approach across a number of different indexes, a number of different investments and sectors, and you're trying to get a little taste of each and also using some hedge in your portfolio. So if, for instance, one particular part of the market is down, which could be international or emerging markets, you have something that is significantly overweight, which would be maybe large cap and small cap U.S. investments right now. So we're going to talk, what is the best thing to be invested in, active or passive investments, and we're also going to just talk a little bit more in detail what active is versus passive. Tyler, let's talk about a couple other things here. What am I missing when we're looking at active versus passive investing?
Yeah, Dean, when it comes to active versus passive investing, well, first off, there's many different investing strategies, and active and passive are two very common ones that are utilized today. They're probably the most two common, so that's why we want to get into them today. It's also important to know that when we talk about each of these, there's really no right or wrong approach, but one strategy might work better for you depending on where you're at right now. And what I mean by that is your investment risk tolerance, your time horizon, your age, your liquidity needs, all that can play a part in what strategy might work better for you. Some other major considerations when it comes to active versus passive would be potential fees and performance. But you need to be able to fully understand active versus passive before making any sort of decision when it comes to your retirement funds and your investment accounts regarding which strategy you might use. So today we're really going to get into active versus passive, which strategies might be better for you, and go from there.
Okay, the first one we're going to talk about is passive investing. And it seems to be it's stereotyped where people see younger people and they'll say that they should be more in a passive portfolio, which we tend to agree with in most cases. And really, there's another term for passive investing or passive portfolios, and that's called buy and hold. So we will see some people who come into our office and they might be in their 60s, sometimes 70s, late 50s, and they're either in retirement or they're looking to retire in the next year or so. And they might be carrying a very passive investment, which when you're younger might have been the best place to be. But as you get older, again, you really don't want to take significant market swings by not moving the portfolio around based on momentum in the market. And part of the reason is that phenomena that happens when everybody retires called no more payroll. So again, your portfolios need to stand on their own 2 feet. They should be managed based on economic situations. So before we go into active, we'll talk a little bit more about passive and some of the things that make up the passive investing. Tyler, let's talk a little bit about buy and hold strategy.
Yep, when it comes to passive investing, so the first strategy that we're going to cover, passive investing, first off, like the name implies, passive investors, they're more likely to utilize the buy and hold strategy. They're passive, they're not actively making moves. The main objective is to buy into different investments based on your current risk tolerance, your time horizon, your age, and then hold them over the long term. Again, based on your risk tolerance. And for an example, if you're in your 30s, you might invest your retirement account in a few different stock funds and then just let those ride for 30 plus years while making minor tweaks and adjustments, with the whole concept or the whole goal is to trying to limit the amount of buying and selling within the portfolios to try and reduce fees and invest for the long term. Now, one thing to really keep in mind when it comes to passive investing is that in order to succeed with this approach, you need to resist the temptation to react to market fluctuations, which can be very hard at times, especially right now with the current stock market that we have. Obviously, it's been very volatile. Right now, we're in early January of 2019. Well, the last quarter of 2018, and more specifically December of 2018, the market's down and it's been all over the place, like you said earlier, Dean, due to different geopolitical events. And if you have a buy and hold strategy, right now it's pretty tempting for a lot of people to try and make moves and maybe want to shift and get more conservative, sell different positions, build up cash. But if you want to have your buy and hold strategy work, again, you need to be in it for the long term and you have to be willing to take some of those dips.
Right. Tyler, you bring up a good point, and I just want to interrupt you for a minute, and that is, we have talked to people, and we heard on the radio, TV, read about it, where some people after the Christmas Eve market downturn, and it went down since then, a lot of people sold out of positions and they got into significantly more conservative positions. Well, you got to look at that and scrutinize it a little bit. You should really get some counsel from, a financial professional, because one of the problems with that is if you had a portfolio that brought you down and you looked at getting considerably conservative at the bottom, your recovery is probably going to be significantly slower. Just as an example, since the Christmas Eve market downturn, the market is up almost 10% from that time period. So for those people who liquidated a lot of their assets when the market went down significantly at that point, probably went into investments or very heavy cash positions, which means their recovery is going to be slower. Now, we have no problem with moving into cash positions to be able to buy lower and then sell high. Everybody wants to do that. But you have to make sure that you're going into cash positions when you have some gains and the market is relatively strong. If you're selling off at the bottom and then buying at the bottom, it just doesn't make a whole lot of sense. So I just wanted to throw that in there because we saw a lot of that. And when it comes to passive investing, a lot of those passive investors realized that in October they had a nice portfolio. It didn't become a bad portfolio in December when the market went down. They hung on to it, and again, their recovery is upwards of 10% right now since the Christmas Eve market downturn.
Exactly. Good point there, Dean. And I know you've said this before, but a lot of people who have had really good performing portfolios in 2017, they're most likely still a good portfolio now. It's just that they're feeling a little bit of the pain of the market, the overall market downturn, not necessarily individual holdings within their portfolio are that bad. The other thing, and you brought up another good point, going back to Christmas Eve day, the market was down. It was really beaten up through the end of 2018. And there were people who wanted to sell off, liquidate all their positions at that time. And now after the first week in January, they want to go back into the market after we've had a gain of 10% or so from that bottom. Well, that's typically not going to work if you want to have a passive investing strategy, because you can't constantly be trying to go in and out based on different market fluctuations. You have to be all in over the long term, and you want to try and reduce the buying and selling. But keep in mind, there's no right or wrong approach. We use both passive and active for different clients that we have, again, based on where they're at. Another thing that I wanted to point out when it comes to passive investing, is the main form of passive investing, which is through index funds. Now, index funds are becoming more and more popular. They weren't as popular in the past, but right now they're becoming really popular because what they do is they have very low internal fees and they simply track a stock market index. Like, for example, the S&P 500, the NASDAQ, the Dow Jones. Those are just a few of the main stock market indexes that an index fund would track. So what they do is whatever the index performs, that's basically what you're going to perform. So you're going to get all the upside of the index, however you're taking all the downside of the index. But with an index fund, they have very low internal fees because there's no active management. There's no one that's buying and selling different stocks based on the market. They're simply mirroring 500 stocks in the S&P 500. So again, very low internal fees, simply tracking an index. That's probably the most easy to understand form of passive investing, where you're simply tracking an index. There's no real buying or selling based on the market. But again, the overall thing to note with passive investing is that, like the name implies, passive investors, they're more likely to utilize that buy and hold strategy over time, with the whole goal to try and limit the amount of buying and selling within portfolios, attempting to reduce fees and invest over the long term.
Okay. The next one we're going to talk about is active investing. We talked about passive investing, mainly a buy and hold strategy. We like to see people in their younger years of investing in passive investments. They go with the dips, they take the peaks, they just keep on dollar cost averaging into these portfolios. Many times they can be more efficient because you're not paying to have them managed. However, once you start getting a little bit older, looking towards retirement, we tend to shift a lot of portfolios into more active investing in managed accounts. And part of the reason is, again, that number one phenomena when you retire, no more payroll. Okay, so what that means is you need to position your portfolios for retirement, and many times an active approach is going to be a little bit more helpful. However, there are different types of investments that you want to target for active investing versus passive. And you also have to look at fees. Okay, many times people think that anytime you bring up the term managed accounts, that they're going to be substantially more fees to them. Well, they could be. Typically, an active portfolio is managed, so you're going to have an investment advisor making a fee by managing the account. However, you can have a very efficient portfolio. And remember, the term efficient when you talk about finance means cheap. Okay, you can have a very cheap internal portfolio by eliminating some very expensive internal feed mutual funds and going more with ETFs and stocks. So there are particular investments we'll talk about that are better served for active versus passive. But the thing with an active portfolio, active managed account, is, again, you can look at economic trends, you can look at geopolitical trends, you can look at things that are happening right now and make some changes and go with the momentum of the market. If the momentum starts to go towards utilities and consumer staples and telecommunications, because we're getting into the late stages of the business cycle and starting to slow down, you can take an active managed account and go more towards that sector or those sectors. Whereas, again, a passive portfolio is typically going to carry the same investments, whether they're slowing down or picking up. And what you'll do is have some winners in the portfolio and some losers. So, Tyler, what else am I missing here with active investing?
Yeah, good points there, Dean. But before I kind of get into active investing, I just wanted to point out one more thing with passive. And again, most people right now who have different retirement accounts, the main form is through their employer-sponsored plan. So again, that's your 401k, 403b, profit sharing plan, whatever it might be that you have through work. Well, by default, most people are actually passive investors when it comes to their retirement accounts through work. And reason being is that usually you only have 10 to 30 different mutual funds to choose from. So it kind of forces you to be passive because you can't constantly buy and sell when you only have limited options. So most people within their 401k should look to be more passive. And what I mean by that is going into the options that have performed the best over time period, again, based on their risk tolerance. But one thing I wanted to note is that most people by default, they will be passive when they're in their working years, and then active investing will come into play more so as they retire and have access to a bunch of different investments after they roll over their 401k or 403b. So to elaborate on that, In active investing now, it takes more of a hands-on approach. As the name implies, you're more active, you're more hands-on with the portfolio, and it requires the portfolio manager to buy and sell different investments within the portfolio, whereas passive, you're buying and holding. Active, you're buying and selling based on a number of different things. Now, active management can be used in many different ways, but a common use is for investors who want upside exposure, meaning they want to participate in market gains when they're doing well. Sure, they might not get the full upside of the market, but more importantly, those who don't want to take on the full risk of the stock market when there's a downturn. Now, if you're a passive investor, and again, you're investing in different index funds, you're going to take on the full upside of that index, which is a good thing when we're in 2017 or when the market's doing really well. However, if we have a market downturn, you're also taking on the full risk and full exposure of the downside whenever you're in an index fund, and it's simply it's going to track that index. So again, you're going to take the full downside. So where active management comes into play is, like I said, people who want to try and get as much upside, but yet it's more important to them to minimize the downside. Now, like you said, Dean, many pre-retirees and retirees prefer an active approach to investing.
Right. Before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, Tyler, just before the break, we were talking about pre-retirees and retirees. Let's elaborate on that a little bit. As I said a little earlier, you tend to see people in their younger years of investing, their accumulation stage of their life, they're more in a passive investing mode. But as we start getting towards retirement, we look at more active investing. Talk about that transition here and what we normally do and how we use a financial plan to determine those things.
Yep. So many pre-retirees and retirees, they go from a passive investing approach when they're contributing to their 401k, their 403b. Then once they retire and they can roll over their account into an IRA outside of work, at that time, a lot of them seem to prefer a more of an active hands-on approach because they're not at a time in their life when they can handle the extreme ups and downs of the stock market like they could have maybe 10, 20, 30 years ago when they were in their working years. Now, what we do for all of our clients is whenever they come in, we'll set up a financial plan, and based on that plan, we can determine where they are, what their goals are, and what approach might work better for them, whether it's a passive approach or an active approach. But when it comes, again, to active investing, it requires more buying and selling based on the different factors such as the market conditions. So if we have a big market downturn, typically actively managed portfolios, they take that into consideration, and what they might do is they might sell off different positions that are more susceptible to a market downturn and shift those over into cash and build up a cash position so you're not as exposed to that market downturn. So market conditions is what active investing takes into consideration. Another thing would be your shifting risk tolerance over time. And what I mean by that is as you get older and older, you're not wanting to be allocated 100% to stocks. You're going to want to move to some bonds, maybe even some annuities and cash positions to try and preserve and protect if we have a big market downturn. So again, with an active investing approach, you're going to make moves within your portfolio over time to get more conservative as well. And another thing would be various investment performance is also what active investing takes into consideration too. When it comes to, if there's, for example, there might be a fund or a stock out there that is lagging behind, it's not performing too well. Well, typically with passive, a passive index fund is going to track an S&P 500. That's the top 500 stocks in the U.S. stock market. If there's one out of those 500 that isn't doing well, it's going to stay there. It's not going to be kicked out. Whereas an active approach, if there's something that's lagging behind and there might be a different fund or a different stock that's doing better, an active manager might kick that bad one out or that poorly performing one out and replace it with another one. So again, active investing requires more buying and selling based on those different factors, the market conditions, risk tolerance, and different investment performance as well.
Okay, Tyler, something else I was just thinking about. First of all, you don't have to have all of your investment money or retirement funds in one or the other. You don't have to have everything in a passive portfolio. You don't have to have everything in an active portfolio. An example comes to mind here is we have a couple coming in tomorrow that they're moving their investments over to our firm, and we looked at their previous portfolio, and they're withdrawing about 3.5% per year from their total portfolio, but their portfolio is so very, very, very conservative that it only generates about 2.5% to 3% gain per year, unless you run into a year like we had in 2018, which took it down even further. And the recovery was very long because they held significant bond positions in there, which unfortunately are not performing real well. So we look at this and we say, well, let's break the portfolio up into a number of different portfolios that we can look at, some active managed, some passive. So what we're doing is if we're taking withdrawals from that account, we have a portfolio that is heavy on dividend production. We want to make sure that we're moving dividend producing blue chip stocks in and out of their preferred stocks or some short-term bond positions or investments like that to continue to help generate income for this couple. But then we also broke the portfolio and put it into something that is built on a little bit more growth and less on the dividend side, so we can get the best of both worlds should the market give us the opportunity. We can get some growth in the portfolio, we can get some dividend production. So the growth portion is very passive. We are staying away from that. We're not withdrawing. We are in that thing for the long term, for the rest of their life. Yes, we'll make some changes to it as we go along, but it's pretty much passive. The active part comes with the withdrawal portion on the portfolio that's set up. We need to make sure that we are pushing in and out of that portfolio well-performing stocks, mutual funds, and ETFs.
Yeah, really good points there, Dean. I just have a couple more to mention on active investing before we move on here. One other thing that I haven't mentioned yet, active investing also takes into consideration different economic conditions. And what I mean by that is usually if you might have a balanced passive fund where you have stocks and you have bonds within there, you're simply going to hold on to that different stock and bond allocation no matter what. Whereas with active management, for example, right now, we have a bond market that isn't doing very well. Bonds, which historically are used for income stability and, primarily income and stability. But right now, the bond market, especially long-term and intermediate-term bonds, are actually down. They're in the red. They're performing poorly. They're not doing what they had done historically. So a lot of active managers are simply kicking those out and replacing those with cash or dividend-paying stocks. So that's another thing where active investing, they also take into consideration different economic conditions, whereas passive doesn't. And the last thing to point out here is that when you compare the both, passive versus active, passive usually is going to be a bit cheaper. Active investing and active management will have a little bit more in terms of internal fees because with active management, there is a portfolio manager that is buying and selling. They're making different moves based on the market, based on your portfolio. So they require a fee for managing the portfolio. Whereas passive investing, they have no portfolio manager needed to manage because all it's doing is tracking an index, so you're not going to pay that fee. So again, just one thing I wanted to point out there, but the main thing to take away from active investing is that it's more of a hands-on approach where you're buying and selling as opposed to just holding over the long term.
Okay, the next topic we're going to talk about is after you sit down with somebody and talk about active portfolios or passive portfolios, the first thing that comes out of their mouth is, which one's better for me? First of all, there's no better. It all depends on your own personal situation. A lot of people bring up Warren Buffett, say he's a buy and hold investor. Well, a couple things. First of all, Warren Buffett does trade in and out of investments consistently. But yes, he does hold on to stocks typically longer than most people, most blue-collar individuals. But you also have to remember, too, that there's such a substantial amount of money there that if a stock goes up 0.25%, that results in millions of dollars in the portfolios of Berkshire Hathaway. So, I just bring that up. People, you'll hear periodically just say, well, if it's good for Warren, it's good for me. Yes, I do understand that. And the best thing is you are investing. That's number one. But really, what's best for you? It's your own personal situation. If you have a very limited amount of money, typically we see those people as they get closer to retirement panic a little bit more when the market starts to show some volatility. And many times, unfortunately, they will take a nice performing passive portfolio, cash out some of it. Unfortunately, emotions take over, and really their recovery is then much slower. And based on their time horizon, they could have left it there and recovered significantly quicker. But Tyler, let's talk about it. Is it age-based exclusively when you talk about active versus passive?
Yeah, good question, Dean. Like you said, we always get the next question, which would be active versus passive. Which approach is better for me? And again, the real answer is that there really is no right or wrong answer, but each one has its place depending on where you're at. So typically, passive investing it's going to be utilized by younger investors who have a long time horizon and can, most importantly, can withstand the market downturns. So again, you're younger, you have a long time horizon. If the market has a big dip, you can withstand that, and you can actually buy into more shares at a low when you're younger, and then come back out of the hole, and you're going to have a higher tolerance for risk because you have, once again, such a long time horizon. So usually we see passive investing utilized more so by younger investors. Passive investing, one other thing to note is that it also comes with lower fees, and I've touched on this already, but you don't have anyone picking stocks or different funds, so the oversight is going to be much less expensive when passive investing, where it simply follows an index. The other thing with passive investing is that it's more tax efficient because the lack of buying and selling typically doesn't result in many capital gains for the year. So if you're not buying and selling, you're not creating any taxable events if you have money that's held within a non-qualified or a non-retirement account. So usually a passive approach is going to be more efficient there because of the tax implications. So again, the main thing when it comes to passive investing, if you have a higher tolerance for risk, a long-term time horizon, and you're younger, usually those are three different triggering mechanisms that we might use for a passive investor. However, when it comes to active investing, we usually see this utilized by many investors who get closer to retirement or who are currently in retirement, and they want their account actively risk managed, where they want to try and pick up on some market upside when it's there. For example, in 2017, they want to try and get market upside. They might not get the whole gain of the stock market. They actually probably won't. But more importantly to them is to try and minimize the downside if we're to have a really volatile, shaky market, kind of like we have the last quarter of 2018, and more specifically December of 2018. So more so active is used by those who are closer to retirement or in retirement. But again, there's no right or wrong answer. It's just that whichever one works better for you, it's usually based on your personal situation. But again, passive is usually used by those who are younger, longer time horizon, higher risk tolerance. Active is usually utilized by those who are in retirement. They might not have that tolerance for risk, and they don't have that longer time horizon, so they need to be more hands-on with their investments.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.